Warren Buffett once said, opportunities come infrequently. So when it's raining gold, put out a bucket, not a thimble. And what he meant by that is when you have a really high conviction, attractive opportunity to invest, don't be timid. Go after it hard. And as an investor, it is important though to first emphasize what truly is a great opportunity, because if you just jump at anything that looks appealing, you're going to end up being left behind. Of course, we're often wrong too, so there is a diversification aspect as well. So you need to balance the two. I can think of several times in my life when I've seen really good opportunities, and sometimes I moved aggressively, sometimes I didn't move aggressively enough. For example, when Energy Transfer had their distribution in late 2020, I saw that they actually had still very stable cash flows. The market was way overreacting and that they were going to have a path to significant deleveraging and eventually restoration of the distribution. So I loaded up, ended up being an amazing investment for me. At the time, it was trading at around $5 a unit, and today it trades at over $16 a unit and has paid significant distributions to me along the way. Another time when I had high conviction was in late 2022. I had very strong conviction in gold. I won't go into all the details why here, but bottom line is I had strong conviction. I started buying it and it's been an incredible investment. Now, earlier this last year, around April, I saw that silver was significantly lagging behind gold, and so I made it my highest conviction pick at the time. However, unfortunately, I was not able to move quickly enough and silver took off. Now, I still should have loaded up because it kept going up and up, and I did have a decent bit, but I wish I had bought more because it went up so fast and so much. And so that's a classic example of when you have high conviction in something, move quickly, move decisively, otherwise it may get away from you. Of course, there have been other times where I've doubled and tripled down on stocks that end up being value traps. And so that's another example where you need to, again, have diversification and humility, realizing that your conviction could be misplaced. But on the net, by moving aggressively on high conviction opportunities at High Yield Investor, we've been able to generate an over 20% annualized rate of return over the 5+ years of our operation, significantly outpacing the S&P 500 and tripling the annualized returns of high yield dividend ETFs that are closest to what kind of pond we fish in. So again, it's paid well for us. Okay, but in today's video, I'm going to share two what I think are extremely attractive opportunities right now that have not been present in either of these sectors in quite some time. And I'm going to share two specific picks, one in each, that I think are a great way to play this. Before I get into the content though, if you like this sort of analysis, whether it be dividend stock analysis, dividend ETF, CEF, portfolio, macro, whatever it is, all focused on being the best dividend investor possible, please like this video, subscribe to the channel, and click that notification button so you can get my latest videos as soon as they come out. Thank you so much. Also, before I get into discussing these great opportunities, there's another opportunity out there that I have personally started to invest in myself, and I have some friends who've been able to do this quite successfully over the years, and that's having an online retail store, whether it be through Amazon or Walmart or any of these other platforms. Now, there's risk involved, like any business, no guaranteed success, but my friends that I know in two in particular who've had considerable success building online retail stores, and so there's a company out there that can help you get started, walk you through it. It's called LimitsExpress. I'll be putting a link to that in the video description and the pinned comment as well, so you can check that out for yourself. I'm just starting the process of investing with them myself, so I thought I'd share that with you. I'll be updating you in future videos how that goes. So again, if you want to check it out for yourself, please check it out in the pinned comment and the video description. They are a professional team that has a track record of helping people build wealth. I know another YouTuber, actually a dividend YouTuber, who invests with them. I've talked to him personally about it and he felt quite good about it. He felt like he had achieved really good returns. So that's why I'm trying it out myself. So anyway, check that out. Make use of that. I also have a free list of Dividend Kings in the pinned comment as well as in the video description. You can check that out to get additional dividend investing ideas that have been proven over the long term and could make you strong returns in the future. Again, as far as the LimitsExpress, I haven't had personal experience with it yet, so I can't promise it's going to be a success. So just do your own due diligence, but I thought you'd like to know about that opportunity. Okay, so now into the content. What are these two big, awesome opportunities? Well, the first one is Sunbelt multifamily. Now, you may be thinking, oh, Sunbelt multifamily, massive overbuilding, rents are down. I saw a chart the other day that rents in Austin have just plummeted since their peak. They went skyrocketing after COVID and then they plummeted down after that. And so many are saying, oh, that's a horrible idea. You're investing in a value trap, a falling knife. Well, perhaps, but I live in a leading Sunbelt market in the DFW area, and the building here of multifamily properties has really come down a lot, and the net absorption is still really strong because people are moving like crazy. Meanwhile, housing is expensive to buy as ever because of where mortgage rates are, and home prices are still quite high. And so renting by comparison is way more economical. In fact, it's scarcely been ever more attractive relative to buying a home. So that's a huge tailwind for multifamily in Sunbelt markets. And because of the population growth dynamics, the business favorability of those markets, especially with things that are going on right now in California, Minnesota, Chicago, New York City. Again, this is not a political statement in and of itself, but it is an acknowledgement that those environments are becoming increasingly less friendly to businesses, and it's a reality. Businesses are fleeing from those regions, going to places like Florida and Texas. And so again, that's a major tailwind for these kinds of multifamily REITs. Now, the key is though that these regions still do face oversupply, and there is a wall of debt maturities that's ongoing, was last year, this year, and it will likely continue into 2027. That's going to cause some of these properties that were underwritten at much lower interest rates, perhaps much higher valuations, will likely be handed back to lenders as this debt comes due, and that will likely put some pressure on the marketplace. That means whatever pick you take needs to have a strong balance sheet, not only to weather this themselves, but to be able to respond opportunistically as properties and portfolios come on sale. Distressed borrowers are looking for help out of their mess. These kind of companies can pounce and set themselves up for long-term growth and profitability. That's why I like Mid-America Apartment Communities, ticker symbol MAA. They are a leading blue chip with a significant concentration in Sunbelt markets, and they trade at a very attractive price, discount to NAV, especially compared to their historic averages, discounted price to AFFO basis as well. They have an attractive dividend yield of just a little bit below 5%. They've got a strong dividend growth track record, an A-rated balance sheet that gives them the firepower needed to take advantage of these kinds of opportunities. Additionally, in their markets, the net absorption rate is strong. Rent is expected to reach an inflection point and begin to grow nicely at some point later this year and certainly into 2027. And so I think now is the time to buy before the market is caught on fully that this pivot is taking place. And that way, even if I'm wrong, you still own MAA, which is a strong balance sheet, high quality assets, good portfolio, good track record. I don't think you're going to suffer over the long term. You may just not make quite as big a returns as I think. But if things really do turn on a risk adjusted basis, I think MAA is a great way to play this trend. Okay, what about the second idea? Again, if you like this content, please give it a like. It means a lot to me. Thanks so much. Okay, so what is the second idea? Well, it's Midstream. Now, Midstream, you may be thinking, oh, that's a terrible idea. You know, oil prices have been coming down. Look what's going on with Venezuela. That could cause some uncertainty as well. Why would you chase Midstream? Well, I'm not just chasing any Midstream stock, but I do believe that the overall sector is attractive because balance sheets have never been stronger. The CapEx cycle is largely coming to a conclusion for a lot of these companies, and they're pivoting towards increased capital returns. And even the ones that are investing in CapEx, it's increasingly towards natural gas, which is a booming sector due to the AI-driven demand. So it's a hidden proxy AI infrastructure play that has that growth tailwind driving it. The yields are extremely compelling, not only from the numbers. For example, AMLP, the Alerian MLP ETF, has like an 8% dividend yield. So that's extremely attractive. Twice what you get from VNQ for REITs, actually more than twice. And so there's the yield side, but it's also well covered by cash flows. Most of these LPs have 1.5 to 2 times coverage of their cash flows, and they're growing their payouts at rates that meet or beat inflation. Even MPLX and Plains All American, for example, they're growing at double-digit rates, and you have EPD, ET, WES, and others who are growing at mid-single-digit rates. So regardless, they're beating inflation with their growth, combined with that high yield, combined with significant coverage, combined with strong investment-grade credit ratings, and their cash flows are very stable. They're not nearly as commodity price sensitive as some of these energy production companies like ExxonMobil or Canadian Natural Resources or Chevron are. These guys generally have 15, 10, 5% exposure to commodity price volatility, and the rest are volume, fee-based, long-term contracts with minimum volume commitments in the vast majority of cases. On top of that, a lot of these contracts have inflation-linked escalators. So every year with inflation, their revenues increase. And so that makes them great stagflationary plays. You get that contracted cash flow and that inflationary bump every year. Plus, again, these incremental capital expenditure opportunities. There's some consolidation going on in the industry with a lot of bolt-on acquisitions and some mergers. And then you also have that extra cash flow that they're retaining, that they're returning to investors at an increasingly brisk pace through distribution growth and through unit repurchases. And so for those reasons, I actually think Enterprise Products Partners is a very compelling way to play this space this year for a couple reasons. First of all, has the best credit rating in the entire sector, an A- rating from S&P, very low leverage ratio, very long duration debt, vast majority of it fixed rate at very attractive interest rates, but also has a strong business model, well diversified across different segments, only has about 15% or so exposure to commodity prices. So again, very stable cash flow profile, has a distribution yield on a next 12-month basis of about 7%. It's covered about 1.6, 1.7 times by distributable cash flow if you project forward cash flows, especially maybe even more. And perhaps best of all, they have an incredible track record of growing their distribution every year for over a quarter century with very strong insider alignment. Insiders own about a third of the equity of the partnership. So all of that put together with also why do I like it so much right now? Well, because they are coming off this CapEx super cycle for themselves. The CapEx is expected to plummet this year, 2026, and not just because it's coming off, but because they're bringing a ton of big projects online, which is going to have this huge effect of as the project comes online, okay, their growth CapEx goes down because they're no longer spending on that project. So that alone increases their free cash flow just from their previous cash flow generation. But then these new projects come online and increase their cash flow. So that's additional cash flow layered on top of it. So if this is their previous free cash flow, you add on this amount for no more growth or the reduction in growth CapEx, several $billion worth. Then additional cash flow coming on from these projects coming online, further boosting the cash flow. And then on top of that, because their EBITDA goes up, their leverage ratio is calculated as what? Net debt to EBITDA. So as their EBITDA comes up from this cash flow coming online from these new projects, their net debt to EBITDA is going to decline significantly, which creates additional capacity in their balance sheet to be able to use more cash flow for something while still staying within their leverage ratio. And so with all that cash flow, management has indicated what they plan to do is they do plan to keep paying down debt just to be as conservative as ever. They've always been a very conservative company. That's part of the reason why they've been so successful over the long term. But they also plan to repurchase units quite aggressively with those proceeds. And that should improve the per unit value because it's going to increase distributable cash flow per unit between the projects coming online and the reduced unit count. That's going to make a big bump in distributable cash flow per unit, which is going to in turn dramatically improve their distribution coverage ratio. And management has indicated they will likely accelerate distribution growth in line with the number of units that they retire so that they can keep their payout ratio in that similar range, that distribution coverage ratio in that range that they have it now. And so that's going to lead to increased distribution growth as well, which will also be a tailwind for units. So I think all that's going to come together this year to really push EPD out of its stagnant trading range it's been in for a long time and finally start making it move higher along with some other MLPs that have done similar things like MPLX, Plains All American, and Western Midstream. When they all pivoted to accelerating capital returns, you'll notice a strong bump in their unit price. Genesis Energy is a smaller one that's done the same thing recently. And I think you're going to see a similar bump for EPD. And for that reason, especially when you combine it with the low risk profile, kind of similar to MAA, an attractive upside catalyst with low long-term downside risk due to the attractive valuation, the strong balance sheet, the strong business model, the strong management. So for those reasons, I think these two on a risk-adjusted basis are some of the most compelling places to put capital to work here in 2026. Again, make sure you check out the link in the video description, the pinned comment for those free Dividend Kings. And also be sure to check out that LimitsExpress opportunity where you can partner with some people who will help you and guide you in building a hopefully profitable online store if you want to further diversify your passive income stream and build your own business online. It's a great way to explore it. It's worked for a friend of mine who's used them directly and two other friends of mine who've done other methods to build online profitable stores. Again, they're not all profitable, no guarantees. I'm just starting it myself, but just thought I'd share it with you as an attractive opportunity. Thank you so much. Again, if you like this content, give the video a thumbs up, subscribe for more like this. Here's to a prosperous 2026 for all of us. God bless you.